Today in the United States, 800 to 900,000 Americans are more than 60 days behind on their mortgage. And this is what you need to be aware of. I'm going to go over the 3 options you have when you start to get behind on your mortgage and what to be aware of and what you can actually take advantage of. Today we're going to go over subject twos, foreclosure, and short sale. First off, we're going to go over subject 2. This is going to be the one that you are going to get bombarded with phone calls. Everyone's going to come and they're going to act like they're the savior and how they're going to be able to help you out of your situation. Yet what they're really doing is they're taking advantage of the situation and not really giving you the clear picture of what can happen. So what happens with the subject 2? A subject 2 means John, say John Doe, is going to call you and he's going to say, I see you are 6 months behind on your mortgage. I'm going to help you out. I'm going to pay and get you up to date on your mortgage and take over the payments for you. They're going to have a contract. And in this contract, you are now selling your house to John Doe and not getting any equity out of it, not getting any cash. Sometimes they even say, here, take $5,000, to be able to move out the house. They even give you a little bit of cash sometimes. Yeah, what they don't tell you is, say you still have 25 years left on that mortgage. Well, that 25 years left on the mortgage can stay under your name with your bank and you're stuck. And say you're looking to go, 3 to 5 years from now and buy a house, you're not gonna be able to buy a home if you still have this on your debt. Now, they'll say you make a rental agreement, we'll do certain things. They're hustlers, they do certain things like that. You do not want this property under your name still, because there could be, with the bank, this is very rare, a bank could say due on sale clause. What that means is, because you're not supposed to sell the property to somebody else when you have a mortgage on it. And if the bank finds out and say you owe $200,000 on the property, the bank could say, hey, we found out that you sold this property to somebody else and we want our $200,000 in the next 60 days. And then you have to figure out how to come up with that $200,000, because the guy that bought a subject to, he's not responsible for that. And now he owns the property. So that is really one of the most riskiest things you can do when you're in this situation. Another thing is, if they go default, say they stop paying and something happens with them and they default on payments, that goes on your credit. That doesn't go on theirs. So if they stop making payments, now you're liable for a property that's not even under your name, which puts you in a very bad situation. So when you get these calls about subject 2, it's going to sound like the answer. And it's not the way to go. It's not what you should do. You're going to put yourself at jeopardy. I'm going to give you one more example on subject 2, then we'll move on to step 2. VA buyer. VA buyer goes, they buy a property, then they buy their secondary property. So they've used their eligibility twice, and now they're maxed out. Now they want to be able to, so this other property they subject to, say 7 years ago. They no longer have anything to do with it, but now they want to buy another property and use their VA eligibility. Well, now they can't do it because of the other property they have no ownership in. The guy they sold it to does, and they can't even take anything out because this guy can now keep the property for up to however long the maturity date for that loan is. So just be careful on that. If you have anybody reach out to you and they say they're a subject to buyer, know that is not the only answer that you can do when selling a property and you do not have equity or you're in a situation. Step 2 is foreclosure. Now, foreclosure, I would avoid that at all angles possible. Foreclosure can affect your credit from up to 150 to 300 points automatically. You also, to be able to buy, it's going to be hard for you to buy it for the next 7 years when you have a foreclosure on your record. So, again, we're behind. What do? Do we just let the property go and just let it foreclose? Do not do that. You're going to have another option, and that's going to be step 3 we're going to go over in a minute. So foreclosure, what will happen? 150 to 300 points automatically off of your credit. So say your credit was 650, Well, now you're down to the 5s, maybe even the 4s. Also, you're gonna have a 7-year ban on buying your next property. So you gotta wait 7 years before you can even own a piece of this earth again. Also, it's gonna be on your record forever, which affects you looking to get credit for other things. So say you just needed a personal loan and things are good. 4 or 5 years later, this being on your record puts you as a risk clause, and for you to be able to get a loan is gonna be very difficult. So foreclosure, avoid it at all causes. Do not let the property just go away. There's another option that you can do, and that is gonna be step 3. So option 3, this is the option I feel you should go with. And not all agents fully understand what short sales are. So a short sale, say you owed on your property $300,000 and you had no equity in it. What would happen is you would reach out to the bank, and you and the bank would put an application in, and the bank would then approve if you are eligible for a short sale. Now, if you're behind on your mortgage, 60 to 90 days, then you are most likely eligible for a short sale. Now, they would then get with your agent, and your agent would send over a CMA and show them exactly what that property is worth in today's market, and then include what closing costs will be from commission to title to HOA transfers, those key closing costs that have to be there. Now, if the buyer is looking for closing concessions, 98% of the time, that is not going to get approved in a short sale. Yet, what will happen is they'll say, okay, $300,000, you owe $298. Yet after this sale, you're gonna walk away with $260 that's what the net sheet's saying. So the bank's gonna say, we'll be good with $260. Go ahead and sell it. We're gonna go ahead and waive the other $30,000, $38,000 that was owed, and we're gonna just take $260 at the end of this sale. This is the better option for you, because now you do not have a foreclosure on your record. The property is now off of your credit, so it no longer says that you owe 123 Main Street for the next 25 years. It's gonna affect your ability to buy for the next 2 to 4 years, yet you will be able to buy again sooner. To be able to get this off of your credit is gonna be easier than a foreclosure. Foreclosure is gonna be there forever. Short sales, you have a rebound period, which is good for you. And you're also gonna get a relocation. So a lot of times they'll even give you a couple $1,000s to be able to move out of the house and be able to get back on your feet. So if you're looking at the 3 options, subject to foreclosure, short sale, go with short sale. Do not go with the other 2, because it puts you at too much liability, and to be able to bounce back from that is gonna take you too long from the foreclosure standpoint. Short sale, the rebound time is gonna be a lot quicker. You'll be able to get back on your feet, be able to, get a couple years to get your finances back in order and get life back on track. If you need more information, reach out to us, subscribe below, let us know. Malouff International Group, let's grow, let's go, let's get it.